Ultimate Options time. I'm Andy Tanner. Welcome. It's so great to have you with us. I'm joined by Corey Halliday for a discussion on risk management this time. Right, Corey?
Risk management, fun topic. Very, very important topic, I should add.
It's the most important of the four pillars. They're all important. We wouldn't want to do one without the other. But if I only had one that I could use, it'd be this one. I would rather throw darts at a stock chart and guess with no fundamentals, no technicals, and just use some options at random cash flow strategies and have solid risk management than missing any other pillar. I wouldn't want to trade with fundamentals and not have any other. I wouldn't want to trade with technicals and not have. This is the only one that I would say, hey, this is the one I got to have, right?
For sure. And the risk management principles we're going to talk about really apply to building wealth in general, managing all of your assets, managing other things you do with your money. So great principles to be learned.
It should go without saying, but we do have to say it. Why do you think there's so many disclaimers about risk, right? And having to be so clear about all securities involves risk. It's what the law, wants all advisors to do and understand. It's what every trader should understand. And so we're going to do education here, and hopefully we can learn more about these risks and some ideas to manage them. I will say this before we get into the 4 or 5 principles is, we talked a little bit about the mindset and the personalized plan. And I would tell you that as you move along the education continuum, right? And we could just draw one here. I didn't think I needed to really include the graphic, but by now, all of us know the education continuum, right? We have ignorance, awareness, competency, and proficiency. And, becoming proficient is about mentoring, coaching, and personalized help. The next step, quite frankly, after Ultimate Options a person would take is to get in a small team, get some group coaching is a good way to go. Find 4 or 5 traders that think like you do, get a common mentor, and just really start personalizing these approaches, because risk is very personal. Risk is very personal. One of the questions I get a lot is they say, Andy, what percentage should I expect? Right? It's a really, it's a question that I don't think is a good question, because it never has a good answer. Like, people want you to say, you should get 20% a year on your money, or 10% a year on your money, or 5% a year on your money. Andy, what percentage returns can I expect if I learn this? And I would say you shouldn't expect anything. You should expect somewhere between making $1 billion and losing everything you have, because that's really, that's the range, because it's a very personal thing. For example, some people have more discipline than others. Some people have more risk tolerance than others. Some people have different ages. Obviously, someone who is younger might take more risk. Someone who's older might be worried about preserving capital. Yet someone who's older and doesn't have a lot of capital, they may feel they need to take more risk to catch up. And so it's a very personal decision. Just as we say in our disclaimer, any decision to trade is a very personal decision that's made yourself. So with that said, what should I go for percentage-wise? Here's might be a better way to look at it, right? Income, expenses, asset, liabilities. Before you decide, what percent return you want to go for, what might be more important is a bigger goal than just percent return. What a lot of people would love to have is some cash in here and some investments in here, some stocks and some options and some paper assets that would help raise their monthly income and get an income that is above their expenses. Most people have a job and they would like someday to not have a job. So if the job goes away, the income from the job goes away, we've got to decide first, probably for most people, what is this number? And so I really don't care what percent return I get as much as I care about having an income that is greater than my expenses. Because when you do that, you might not be a millionaire, but you still might be able to retire depending on how well you do. And so, that's really what you want to go after. And so we'll talk about what to do with certain amounts of money and what to do to build it and how compounding works. And it's maybe less about net worth for some people and more about cash flow and driving this number higher. And so, how much you start with? Well, you start where you are. Someone once said, how much money should I start with? I says, well, the ideal amount. They go, yeah, what's the ideal amount? I said, probably 12, 15 billion would be ideal if you could start with that. And I said, look, another bad question, quite frankly, because you got to start where you are anyway, right? You got to start where you are anyway. And so, take in consideration the risk management is more important than what you can go for. And so we'll talk about these. So first lesson. Go ahead.
And importantly, one thing is there's risk in not doing anything.
Yes.
So people say, well, I'm going to avoid the markets because I could lose money if I get involved in the markets. Well, yeah, if you stay in cash and you put your money in the mattress, there's risk in that. And in fact, do you expect better returns having your money in the mattress? And, what if your house burns down? Then that money in the mattress is gone. Or what if, there's all sorts of what ifs. So there are no guarantees. There's no guarantees in anything that you do with your money. But there's a better way historically, right? We can only use history and statistics and kind of the common sense approach of assets go up in value in part because of inflation. It's going to cost me more to go buy things in the grocery store. I'm going to assume that milk is going to cost more 20 years from now. Well, the company selling that milk is thus going to probably make more money and have a higher profit margin, and thus their stock is probably going to be higher. And, so it's important to kind of keep those things in mind where when we talk about there is risk, there's risk, but we can manage it. And importantly, this is a much better, and investing is a much better area to tap into than to just do nothing and say, well, there's risk everywhere, so I'm just going to do nothing with it. Well, that sounds like about the worst approach to me anyway.
Let's say someone is 75 years old. Okay, he's 10 years past his retirement age. He's still having to work, and he's got $5,000 to his name. How careful does this person need to be? Well, the answer might be for a financial advisor. They'll do what's called a suitability interview. They'll look at this guy's age and they'll say, oh my gosh, you can't afford to lose anything because you just don't have much. But the guy personally might say, well, listen, nice to say financial advisor, but if I put this in a bond and I get, 1% on it, some government bond, get 1 or 2% on it, that's not going to help me much. And I'm going to run out of this. If I have, $500 a month in expenses or $1,500 a month in expenses, that's going to last me 4 or 5 months anyway. I just as well put this into a business and try to generate something fast. Or, I might I'll tell you what I would do. If I only had $5,000 to my name, that's all I had, I'd buy a course on how to make money. I'd buy a real estate investing course or some course on how to I would buy a course on how to raise capital. If all I had was $5,000 to my name, I would buy a course on how to raise money. But that's not what a financial advisor may tell you, right? They might say, look, as old as this guy is, because they don't want to get sued. And if you lose money, you go and say, oh, look at this, older gentleman, who's a senior, and look, he took all his money, invested, and he lost it, and this brokerage is terrible. So it really is a personal decision. My feeling is the difference between 5K and zero is negligible at that stage in life. 0,000 and 5,000 is pretty much the same number in my mind because they have about the same amount of buying power.
You can't live on either one.
Nope.
Yeah.
Lesson number 1 on risk management: position size. This is the number one way people blow up their account is they put too much money in one position. This is number one absolute risk management rule that I can give you. The reason the casinos have a table limit is because they're going to minimize or manage the position size of any bet. If you go to Vegas and you're on maybe a $5 table, they'll say minimum is $5, and then they'll say, but the maximum is $100, and that means that's as much as they're going to be able to bet on that roulette table or whatever. And so if the casino loses, this is the max position size that they can lose. Now, I won't tell anyone. I refuse to get boxed into saying, okay, what's the perfect percentage? Because, again, that's going to be a personal decision. What I will tell you is that if you look at people that trade, like Corey, you used to manage a whole floor of traders, right? Guys that did this. I mean, these guys were, that's what they did. They were traders. And I would guess, and I haven't talked to you about this, Corey, so I'm just going to guess, but I would say they would probably not risk any more than 1 to 3% of their account size. So let's talk about what that means. That means that if I had a $100,000 account, what does that mean? And first of all, do you agree or not? I mean, was I right in that guess or wrong? Was it higher, lower, or was it lower?
My answer was going to be, on average, they risk maybe about 1 to 2% of their account size. So 1 to 3 is pretty darn close.
Yeah,
so
this is
1 to
very
2%,
aggressive.
Yeah, and understand that most people, when they first get involved, they think a lot higher than that. A lot of people think, well, I'm going to put, I have $10,000. I'm going to put $1,000 into each trade, or I'm going to put $2,000 or $5,000, and that's crazy extreme in terms of high percentages. Because if you have a $10,000 account and you put $1,000 in, that's 10% of your equity. And importantly, you are bound to have a losing streak at some point of 3, 4, 5, 6 trades in a row. And that sounds terrible, but at 1 to 2% of your total portfolio, you can weather that storm relatively easy.
Right.
And that's the important thing, is really professional traders think in terms of longevity. We're not in it to make money this week. We're in it to make money over the course of 20, 30, 40 years. So the first rule is survival, right? I'm going to make sure that no matter what, I'm going to make it through. And so, 1 to 2%, perfect. 1 to 3% is reasonable in terms of what most professional traders kind of look at.
If you have $100,000 and you lose half that money, you've had a 50% loss in your account. But and so it's pretty easy to lose half, okay, to have a 50% loss in an account. But now what you have to do, is now you have to double your money to get to $100,000. You got to have 100% performance to get back to even. Do you subscribe to that thinking, or is that just foolish numbers?
No, that's exactly right. I mean, if you experience a 50% drawdown, you now have $50,000. You have to make a 100% return to get back to break even, get back to 100%.
So let's say you put all your money in one stock, and the stock was at $100 and the stock went down to $50. You'd have 50% drop in the stock. Now this stock has to double and go to 100% for you to get that money back. It is more likely to have a 50% drop than maybe a doubling of the stock in some cases. So what Corey and I are saying is, we can't make a recommendation here. We can't say, okay, the perfect amount is 1 or 2%. All we can say is that, because it might be less for you, it might be more. That is where we draw the line on advice. But what we will say legally is to say that is very common for traders to do. And you got to look at your own personal risk tolerance, age, all that type of stuff. Now, let's talk about what that really means, okay? Let's say you have a $100,000 account. Some of you might have less, some of you might have more. But let's say that's your account size. So 1% of that would be $1,000. Okay, that means that if you lost, you would take $1,000 hit. Now, Corey, tell me what that means, because there's two things. Let's start with a stock. Okay, let's just start with a stock. Let's say that there's two rules of thumb. If I say, here is my entry, and here is my target, and here is my exit, okay? And let's say the stock is $10 a share right now, okay? And I want to buy it $10 a share. How many shares in your mind could I buy? Now, if I have $1,000 and I buy $1,000 worth, 1,000 divided by 10 to be 100 shares. Okay, 100 shares if I were to lose the whole thing. Make sense? But the other way you can look at it is if I have it here, an entry at 10, and my target is 15 and my exit is 9, now if it goes down and I sell at 9, I'm going to lose basically $1 per share. So does that mean I can buy 1,000 shares? Which one is the way you would think about this as a risk manager? 100 share position where I could lose the whole thing and be 1,000, or 1,000 share position, and if it went down $1, I'd lose $1,000. Does that make sense to you?
So, yeah, exactly. And with stock, it's usually the $10 entry, $9 exit. So we have a stop loss in place. Our anticipated risk is normally how we would position size with the stock, right? So we're anticipating risk of $1 per share. So
yes.
I could risk, in this case, I'm going to say I could buy 1,000 shares, because if this stock that I buy at 10 goes to 9, I lost $100 per share, or I have 1,000 shares. At dollar per share is $1,000. Does that make sense?
Yep. So
if I had only owned 100 shares, it's pretty simple. If I bought 100 shares at $10 per share and I sold them at 9, I'd lose $1 per share times 100 would be $100.
Yeah.
Well, if I have 1,000 shares, it's $1,000, right?
Yeah.
So we would position size normally with stock in terms of our anticipated risk. And here's an important point why. With stock, it's highly, highly unlikely. In fact, I can't ever remember a stock opening that just on one day and being at 0. At worth 10, and then the next day it's at 0. It doesn't happen that way. Now it could gap down. It could, it could have closed yesterday at 10 and opened today at 6 or at 5. That's possible.
And if you're trading, And if you're trading a pharmaceutical that's very volatile and has a history of gap and stuff like that, and it's only a $10 stock, don't be surprised if it could would happen. So you want to take that in mind as well.
But normally we would kind of think, okay, even if this stock really gets hit, I'm going to get out probably around 9. I'm not going to assume that there's, let me put it this way. It's just as likely to gap in your favor as to gap against you. Right. And if it had gapped in your favor, you'd have made the money. If it gaps against you, you'd have lost the money. So in terms of our exit, we can make a pretty good compelling argument that most of the time, if I have a stop loss at 9, I'm going to get out at 9 with the stock. So I can position size for my anticipated risk in the stock. In the options market, I'm going to do the same thing. But in the options market, I would normally position size for max loss, meaning I'm not going to assume anything with the options because it is more likely that an option could be worth $1 or $2 and then open the next day almost worth nothing, because it wouldn't take as big of a price move. A stock's not going to go to 0 as often as an option can go to 0, right? And so we position size with stock towards the anticipated risk. We position size in options normally for max potential risk.
Yeah. So when you are an option, now this is very important. So when you are an option buyer, you are long an option, and you're going to buy an option, the maximum risk is premium paid. So if the premium was, say, $5, right? $5 a share, okay? If I have a 1% tolerance, right? A 1%, is my max here. 1% position size, then the most I can lose is 1,000. So I'd have to say, all right, if the premium is $5, then what is that? That'd be two contracts.
Two contracts.
Yeah, it'd be two contracts.
If this was a call option or a put option that you're buying and it's trading for $5 per contract, that represents $500, right?
Yep.
So per contract, we're putting $500 into the trade. And notice we're now going to position size towards the max potential loss. Now, in terms of this trade, you might still have a different anticipated risk, because you might say, you know what, I'm paying $5 for this option.
Yeah.
But really, I plan to bail on it if it gets to $3. You can have a game plan around it where you're going to exit early and you're going to lose less. But normally a trader would position size more towards
max risk,
what could happen in the option.
Yeah. Worst case scenario.
So if I put $1,000 in, I'm going to position size that towards my max tolerance. If I say I'm willing to risk $1,000 per trade, even though my plan is to lose less than that, if it costs for two contracts $1,000, then I'd position size around that two contracts.
What's nice is if you were to buy an option, maybe this is a 4-month option or a 3-month option, there's a real good chance that this could be a $50 stock. If you got 200 shares of that, you got $10,000 worth of stuff you're controlling for $1,000, right, Corey? So
yep,
you're really
exactly.
you're really controlling a lot. You got a lot of leverage here. You have no debt, but you have leverage by contract. So we've talked about, let's just review. We've talked about a couple things. First, we talked about stock. And with stock, we're going to position ourselves for an entry. Let's just write it out. An entry. We're going to position ourselves for a target. We're going to talk more about this in a minute. And we're going to position ourselves for an exit. And we're going to get some high liquid stocks. It's not guaranteed that they wouldn't gap down at all. But we're going to say, hey, we feel that for most of the time, the distance between here and here is our risk. That's what we're going to see as our risk. Okay, now we have a long option. And in this case, our maximum risk is the premium paid. And we're going to position to the full size there. Even though we might even do this with the option. We might say, all right, I'm buying it for 5. If it gets to 8, I'm going to sell it. If it drops to 4, I'm going to get out of it, and I'm only going to lose $1. Even though it's just easier to lose the money in the option. So we're going to say this is premium paid is going to be our max risk. Okay, now we have to consider this one too, Corey, is the short option. And what the short option is, how we look at our risk, is what did we promise? That's what we're going to ask. What did we promise? And so talk a little bit about the promise that you make. This is going to be different because if I sell a put with the idea of buying the stock, then I'm probably more thinking like stock, wouldn't you say? If I really want to own this stock and I do a put by itself that's called a cash covered put, I'm probably going to treat it more like this stock. Would you agree?
That's right. And you have a margin of safety in it because when you're collecting a premium, you're insured against a certain amount of risk.
Yep.
And you can kind of think of that like the insurance business where, you know, as an insurance company, you're collecting premium. Let's say we're going to insure a car against damage. Well, if that person damages their car just a little bit, sometimes they won't even notify the insurance company because it's not worth it, the deductibles and, you know, all these things. And they just say, you know what, I'm going to take this one. And that's kind of how it works with this short option. You're collecting a premium. So the first little bit of losses in the stock normally are not a problem. it's if the stock were to move more than that, it's more of kind of a bigger move and more extreme move against you where you can get hurt selling an option, like a cash covered put in your example.
Yeah.
So we would position size it more like the stock in that, okay, here's what I'm planning for. Here's kind of where I think the stock could go, or how many shares I'm willing to take in if I want to have the stock put to me. And I'm gonna work through some numbers and err on the side of being more conservative. And so you'll notice we're kind of taking a more conservative route in all of these, and that's for longevity purposes, right?
Right.
I have a trading friend that says something I think so great. He says, "Is this the hill you're willing to die on?"
Yeah.
And when you think about that, sometimes traders, they'll unintentionally get into some stock that just becomes such a big portion. And basically they're saying, I'm all in on this one. They just keep adding to this bad trade, and they double down and they keep buying dollar cost averaging or whatever. And basically they're saying, this is the hill that I'm willing to die on. I'm all in on this one, And so we never want to be in that situation.
Never.
We'd never put ourselves in that situation where we're just going to manage the risk. So if we sell an option, we're going to say, okay, here's what our expectations are. If it starts to get to these levels, then we start to hedge. We start to manage risk. So we start to take measures where we reduce our risk and we're only comfortable with a certain amount. And at that point, we'd cap it off. We would make an adjustment to the trade where we delta hedge or do some things that we'll show you.
Now, I'm going to skip ahead and we'll learn about this later. So don't worry if you have a basic understanding of the principle of, look, don't get too big in one position. That's fine. We'll get more detailed as we get into individual strategies with this position sizing idea, right? But let's say I'm in a credit trade, like a credit spread, and I see that what I promised, if everything went bad, let's say if everything went bad, I'd be out $1,000. Okay, if everything went bad, and maybe I'm going to make $100 credit is my reward, and my worst case scenario is $1,000. Maybe it's an iron condor or something like that. Okay, what would you say it is right here? Is it saying, well, I'm never going to take a max loss, so it's 500 and I'll do 2 contracts, or do I say, you know what? This is the max that could happen. I'm only going to do 1 contract because I could lose the full 1,000. Which of these ideas are we after? Are we going to treat it more like the stock or more like the option when I look at max risk?
Yeah, I'm going to treat it more like the option, where I'm going to say, okay, I'm taking this credit spread. I'm going to assume that I could lose the full amount, right? I'm going to assume that $1,000 is possible, even though I've got a game plan going in that is really going to negate that, right? I'm going to say, okay, I'm probably going to take this off at a $300 or $400 loss. And we showed in a prior class that example of bringing in $100, bringing in 100, and then taking that lesser loss. So important that even though you've planned for the worst, you want to improve upon that. So you start off with, what's my worst case scenario? My worst case scenario, and this is the great thing about options, we can put on a credit spread where we say, even in the worst case scenario, which I'm going to avoid at all costs, even in the worst case, I'm only going to lose that 1% or 2% that you're comfortable with. And so again, it's a personal decision. How much are you willing to risk? But once you've decided upon that, you can now position size for that. And so if I put on this credit spread, I know even in the worst case scenario, I'm comfortable with that number. And now I can start to manage the risk to improve upon that. So instead of taking $1,000 loss, you know what? I get out of that one for a $200 loss, and I move on and I start making the $100 and the $100 more consistently. So that's good trading.
But we have to position size to the max risk of an option, right? We have to position size. And the only exception I would say to that on a short option is a cash covered put where I really want to buy the stock. In that case, I can treat it more like a stock, but I can't really think of another case where I would do that. I'm gonna position size to max risk. Would you agree?
Yep, I would agree completely.
Okay. The number one thing, so if you have an issue and you blow up your account and you fail, the first question I'm going to ask you is, how big did you go? How big did you go? And the thing, and I'll tell you, this is why we did mindset before this one, is the thing that makes people go too big is greed, and it's just plain and simple. They see those percentages, they see how often they've won. Look, if you remember from the last lesson, we had month 1 through month 10, and we were cranking 100 and 100 and 100 and 100 and 100. And when you crank that 5 months in a row, and it was piece of cake, and it was gravy, and it was 90% probability in every one, it is so easy to say, well, this could have been 1,000, 1,000, 1,000, 1,000. It's really easy to think that $500 could have been 5,000. And so what do? You say, you know what, I'm going to risk more on this one. And that's where you just get killed. Because if you only made 100 here and all of a sudden you risk big and then you lose 10,000, you're dead in the water. I mean, it just wipes out all your gains, and now you're dead. You're absolutely dead. And so the idea of greed is the greed and the thinking, man, I could make so much. That's gambling. That's gambling. So, you choose what it is. If you want to choose 1% to 2%, that's going to be your choice. We won't give advice on that. But what I will say is not paying attention and having a rule for position size is less smart than having a rule for position size. This is first on the list because, again, this is the number one mistake of option traders right here, is getting greedy and going too big. The other thing is you don't have to have all your money in. If you are a member of our Mentor Club, we have a big 6-figure account in that paper trade account, and we probably, and plus with margin, our buying power doubles. We probably only use about $20,000 to $30,000 of that buying power at any one time just to teach. So there's no rule that says you have to have all, if you have a $100,000 account, there's no rule that says you have to have all of that $100,000 out there exposed to risk. We're just saying that in any one position, you probably don't want to have, too much. Anything you want to say about that, Corey, before we go to the next principle?
Yeah, I agree completely. I mean, a lot of times in the options market, especially, you're really not going to have most of that capital. So if you have a $100,000 account, you might be using 20,000 of it, 30,000 of it in options. You might be using some of it for stock hedges, and then you might have some of it in, risk-free, low yielding, but low risk kind of
money market
income stream, or money markets, and even like 3-month treasuries or T-bills or what have you. So you can do some different things with it, where that's the beauty of options. I mean, you're really putting on a trade in the options market where for $1,000 at risk, you might be controlling, it's tying up $1,000 of your money, but you're controlling $20,000 or $30,000 worth of stock with it. So you don't need to use a ton of the capital for that. And that still helps to generate those nice returns.
Some people and some financial advisors will create a pyramid of risk and the amount of money that's in there. And so they'll put, low risk here, high risk here. This is definitely where the options would be. We don't need to put a lot of money into options to get great returns. And we might even put more money in some of the lower risk stuff. So just remember that you do not need to have all of your account working in options. And when you do, 1%, 2% of the position size is what a lot of people choose. You'll have to make that decision yourself. Biggest lesson we can give you on risk management is as you move forward, position size. Again, I have appreciated your willingness to be coached Mr. Miyagi style, because ask yourself again, I know how people are. Andy, when do we get to learn the naked call? Andy, when do we get to learn the naked put and the covered call and the iron condor? Show me the nuts and bolts. Show me. But let me ask you, is this a lesson that we're having right now, something you should learn after learning how to do an iron condor or before learning how to do an iron condor? I'm telling you, we're going to do this in the right order, and you can feel good inside right now by saying, you know what, this is something I really want to learn and get solidified in my mind before I trade an option at all. So that's great counsel, Corey. Test your trade. What does TEST stand for, Corey?
Yeah, so time frame, entry, stop loss, and target. TEST. So we have, when you think about this in terms of trading, we're going to test our trade before we put it on. Think about your time frame. You've got to have an idea as far as what's my expected time to be in this. Is it a 3-month trade? Is it a 2-week trade? We know that in the options market, we're going to select specific expiration dates. So we want to have an understanding of time frame. And some traders will have a time frame on risk as well. They'll say, if this trade's not working within 2 weeks, I'm out of here. If it's working for the first couple of weeks, I'll hold on to it a little bit longer. So, time frame can mean a couple of things, but the first thing it means is how long are you anticipating to be in this? Entry is what's your call to action, right? Why are we getting in? Stop loss would be protective, and then target's obviously a take profit. So we'll touch each one.
Is entry, how do you spell entry the right way? I should learn that.
ENTRY. Yep.
I thought I spelled it right. There's your entry, correct? And I've taught this even in your 4 pillars class is target. Where do you think it's likely to go? What are your reasons for that? And then your exit. We do not trade without those things. Now, if someone came to me and they said, I want to buy some, insane, cryptocurrency, or I want to buy a penny stock, or I want to buy an IPO and something, nutty risky, where there weren't a lot of fundamentals on it and there weren't a lot of technicals on it, and you were just going to do a crapshoot, I would tell them a couple things. Number one, I'd say position size and figure how much you could lose. So if you want to go out and buy a cryptocurrency and put $10,000 in it, just understand, be willing to lose the $10,000 and sleep at night, right? And position size to loss, to risk tolerance. And then number 2 is, if you don't have anything else, at least set these up, a target. If you don't have a target in mind, that's insane to trade it. I say, well, how high do you think it just go? Well, I don't know. I just think it might go big. Would you ever get an investment without at least a goal of return? I'm not a house flipper. I don't like flipping houses, but I have friends that have been extremely successful doing it. And one of my friends that does this is Than Merrill. This guy has a company. He flips 100 houses a year. He's done it for a decade. And I'll tell you, that guy, unless he thinks he can make $30,000, $40,000 on that flip, it's not even worth his time. And so he has a target. Now, he doesn't always hit it, and sometimes he exceeds it. He doesn't hit it perfectly every time. He rarely loses money. But why would you ever? That's like going to a job interview, and they say, great, just show up at Monday, and we'll give you your desk and go. And you say, well, how much am I going to get paid? And they say, well, I don't know, something. Could be a lot, could be a little. That's nuts. That's even an employee should understand that. Even an employee should understand, I should have a good idea of what I think I can make before I show up to work on Monday. Well, the same's true here. And then we've got to have this exit by saying, look, if you're going to put, $10,000 into something, you got to have that say, okay, well, I think I can make 15, and I think I can make, maybe lose 1,000, and that's my line in the sand. Now, it might go and gap down and be worse than that, but that, at least with the stock, is what it should be. With an option, as we look at the entry, we'll talk more about these specifically, and we look at the target, and we look at the exit. Let's put that in red. I will tell you, with stock, I would like to have a ratio of $2 in reward for every $1 of risk minimum that I take. And you can develop your own. Again, we can't give you financial advice, say that's exactly what you should do. What I'm saying is find what's called a reward to risk ratio, and you should probably have more reward than risk in a stock anyway, because the probability is really 50-50 on these. And if the probability,
and I agree with that. That would be a directional style. So when you're doing a directional style of trade, meaning, I think it's going to go up, but it could go down. It's a 50-50 type of probability. We normally want to position those for bigger reward and lesser risk. What's interesting about the options world is sometimes we're willing to take more risk than reward because that probability is way different, right? Probability might be sky high on an option trade we put on.
Correct. So on a target, what do you see as a risk reward ratio? Maybe for a long call or a long put.
Yeah, I would do the same type of thing where I'd look for a 2-to-1, that type of reward to risk. So if I'm buying a call option for, let's say, $4 per contract, I might have a goal for it to double in value to $8. That would make $4 a profit. Well, I might risk $2 if I was wrong, right? So I buy at $4. I'd be willing to risk $2 to make $4, that sort of thing.
If you're buying it at the money, which is usually close or slightly in the money, there's probably a 50-50 chance it works out for you. Now, if we start doing short options, we might only have a $1 reward and we might have a $10 risk. We'll talk more about this. We would only do that if our probability was like 90% or something like that. So
and not only is it the probability sky high like that, but we can manage it down even further, so that our max risk is this, but our probable risk can be even much lower, So worst case 10, but we'll probably be able to get out for 5 or 4 or 3.
So we're going to talk more about probability and what I call the big 3, but for now, let's take these down. So time. What is my time frame? And you have this. You have basically a stock. You have basically a long option. We'll just do a long option where it's a debit trade. And then we'll have our short option. And this is not in stone, okay? This is just a guideline, okay? A stock might, if you're a day trader, you might be in that thing 5 minutes all the way to, 100 years in stock. You can have a long-term, if your idea is you want to buy Verizon and get that 4 or 5% dividend that they like to pay, and you want to hold that thing like Warren Buffett has held Coke, and sell calls on. You might say, I want to own this stock for a long, long time, and my exit might be determined by the price, not the time frame. Or you might be a swing trader, and you might say, look, I'm going to have an entry and a target and an exit, and when I get in this trade, when it hits the target, I'm going to go ahead and get out, and I think that could happen within maybe 3 weeks if you're a swing trader, or 4 or 5 days if you're a swing trader, right, Corey, or position trader.
That's right.
Yep. You might, though, say, look, if this doesn't go anywhere and it doesn't do what I wanted it to do, you might say, look, I'm going to get out of it after a week. If it's sitting there, maybe you have something in a high base and you think it might go up again, but it doesn't. It just sits there. Maybe you have a time stop. So for stock, there's guys that day trade that are in it for like 1 minute. There's scalpers that are in it for 1 second, right? That's usually not where we are, and this is an options class. So as far as a long option goes, when I buy one, Corey, we talked about time decay. I really like to have, over 6 weeks. In fact, I like to have 3 months usually when I buy an option. That doesn't mean I'm going to hold it till fruition. I usually just buy them 3 months out thinking this thing might make a move in, 3-4 weeks, but I want plenty of time. What would you say about the time frame for a long option?
Exactly. Have an idea of where this stock's going to go over this next time period, but and I love it. Buy a 3-month option, game plan to get out when it has 2 months left. You're going to experience less time decay. You're going to have more of the benefit and less of the drawdown, because we know the long option trader, right? Time is working against them. It's ticking away, but at least that theta is lower because we bought a longer term option instead of a shorter term option. So, yep, great analogy there.
If I'm short, if I have a net credit trade and I'm short, I usually don't like those. 6 weeks is about my max, and you'll be like 3 days, right? You'll do these very short term, 3-4 days. I don't mind doing a month. Rarely do I go further than 6 weeks because of time decay. So that's your T for time. With stock, really varies on what your goal for the stock is. Long option positions can be 3 months or more. Leaps can be a year, right? If you want to do some calendar spreads maybe and sell some calls against some leaps. Leapses, I guess you'd call it, right? Leapses. And then your short option 6 weeks or less. Let's talk about entry. When we enter, we're going to do a little review of the 4 pillars. But when we enter, we want to have a good feeling of our fundamental analysis. Sometimes that's really important. I say the longer you're planning on holding it, the more important this is. The less you're planning on holding it, the less important this is. But I want to have fundamentals on the stock, but I also want to understand fundamentals of the world. In other words, the economy and the market. And both of these are important. The shorter term, this is probably less important, and this is probably more important. Technical analysis, I like to have, more than one reason. I like to have the right trend. Then I also like to have what might be a catalyst, like I might see a candle that might be, or I might see some technical indicator, or I might see it break through support or resistance. I'm going to have some type of trigger, some type of catalyst, something that says, bam, I think this could pop.
And that's your call to action. That's what an entry is why are you doing it here? Why are you doing it now? Why at these prices? And so we want to have those reasons, right? Fundamentally based and technically based. Why now? And so if you have a good answer for that, hey, fundamentally this is a good environment for buying the stock, and it's got great fundamentals. It's heavy on cash flow. I think they're going to raise their dividend, and then technically it's breaking out through resistance. It looks like it's going to run up to this next resistance line, which would give me a nice big profit, So we have a reasoning, a justification for the entry.
That can help us be more profitable, and stocks are less risky when you're doing it right. Doesn't take away the risk. And you'll notice that in our, a couple of episodes ago, we did order entry. And so you can really say, well, the market gets you in right now. A limit gets you in at a certain price, right here. And a stop limit gets you, is kind of a win, right?
Yeah.
Which is right here. So win. So by using order entry, we can take control of when we enter the trade and make it under prime conditions. And that can help us manage risk, because then we're not getting into stocks that are headed the wrong way. We're getting into stocks that are headed the way we wanted them to head, if that makes sense. Yep. This is just huge, is we're going to talk about a stop. And this is really a decision to get out of the trade. And the most important word I can give you here is this word right here, is the word before. We don't go into something without knowing how we're going to get out. That just makes sense. We don't go into a room not knowing how we're going to get out. We don't go into a trade not knowing how we're going to get out. And what a stop is really when we decide we're going to leave. And there's going to be hedging. There's different ways to do it. You can have an order that gets you out to just leave the trade. You can have a contract, like a put option, for example, that guarantees when you can sell and you can get out. There's all types of different things you can do, but we will have every time saying, look, this is the max amount we're going to lose. And we're going to make a plan to get out before we lose that max amount of money. Would you agree?
Yeah, absolutely. I mean, you think about it from the risk management standpoint. This is knowing your stop is how you know how to position size. So you really can't pick a position size, how many shares you're going to buy or anything, until you've analyzed these things. Because if you don't know where you're going to get out if this trade isn't working, then you don't know what your risk is. And if you don't know what your risk is, and you're just kind of buying blindly. I mean, how are you deciding how much to buy? You're just guessing at it. And sometimes, you guess right and sometimes you guess wrong, but that's a pretty risky way to do it. So we don't want to go that route. We say, where am I going to get out if I'm wrong? How much of a loss would that be? Am I comfortable with that? Perfect. And then I move forward.
Bam. Absolutely true. Target. I covered this a little bit. I might have got a little ahead of myself, but if you were going to get a job, you'd probably want to know what it pays before you started. And so, for example, a long time ago, people were asking me about Bitcoin. Once it hit about 10K, I don't remember when this was, but once it hit about 10K, people started talking about it or whatever, right? They started talking about it. And they said, I want to buy it. And this was my favorite question to ask people. I go, okay, well, where do you think it's going to go? And most of them had no idea. Some people said 1 million, I says, well, great.
Yeah.
Why then? And remember the questions Corey asked on entry is, why now, right? And why get in here? These same two questions apply here is, why do you think it will get to this target, and how long do you think it'll take to get there should be in your mind. And the way we usually do this is with technical analysis and sometimes with fundamentals. With fundamentals, you can do it based on earnings and growth. You'll say, well, look, I think we're going to have this many earnings and this much growth by next year, which should, give us a stock price at such and such. And a lot of analysts will do that, right, Corey? They'll say, all right, given this company's growth and given the earnings that we expect to see, that should put the stock price about X if we maintain the current PE ratio we have. So you can do it fundamentally. But more popular setting targets is you might have a chart, and maybe the chart looks like this. And you say, it's gone about this far each time, and it's taken about this long to do it. So I would say, hey, I think that is a likely target. Or I might draw some support and resistance lines and think it can hit there. Or maybe I had this thing down here and it had a gap down, and I say, well, I think it might fill its gap. That's my new target. So your technical analysis skills will come in handy. You can use Fibonacci retracements, and there's all kinds of tools to set targets with. Anything you want to say on that?
Yeah, I mean, it's a great principle in terms of your target is your reward. So just as we want to go in with an amount of risk in mind, we really want to know what our potential reward is, because again, that helps us with position sizing. And especially in directional trading, where if you're buying a stock or you're buying an option, you want to have an idea of both sides, because then we can analyze it effectively and we can say, okay, this makes sense. My target is twice as high as my downside risk. And I think that's probable. I think it's going there. This thing is going to fill that gap, or this thing is going up to the upper channel line. So knowing where your target is gives you a reasonable expectation for how the stock is going to trade. And it also helps you along the way, because I always try to identify the likely outcome.
Right.
And then I can kind of tweak and make adjustments. I can say, you know what, this is kind of flattening out. It's just not showing that upward momentum. So I'm going to downgrade my target. I'm going to flip this trade into a sideways transaction. So now I'm going to make money if this thing just kind of continues to channel here sideways. And by knowing what the expectation was, I had a better idea of the adjustment I needed to make when that wasn't happening. And so again, paper trading, we always come back to it, but this is like exercise. The more you do it, the stronger it becomes. So start doing that. Break it down and say, what would be a reasonable target here? Look at the chart and make an educated estimate. That's all it is, of how far it can go. And then put on your trade, have an idea of, okay, here's my upside, here's my downside. Start to follow that transaction, and you'll see, you'll start to get really good at picking your spots, analyzing those trades, and identifying targets.
If you look at 30 33%, 33%, and 33%. Let's say that a third of the time the stock's down and you get out. And let's say the other third of the time the stock stagnates and you have a time stop and you just get out at break even. So right here, let's say you're losing 1, and right here you're losing 0. But let's say the other third of the time it goes up and you get your 2. Well, that's a pretty good thing, because if you add all those 3 together, you're up $1. And that's not perfect, but it's a good way to look at it, right? Is a third of the time it goes down, a third of the time it stays the same. This doesn't really happen as much. And then a third of the time, it goes up. And if you get rewarded more on the up than you do on the down, that's the beginning of a winning formula anyway. It's not guaranteed. But you cannot get the reward and the risk, and this is a class on what? Risk management. You cannot identify the reward and the risk unless you identify the time you're going to be in it, the entry, the exit, and the target. We can't get risk without these ideas. We can't get a risk-reward ratio and manage that risk without testing. Without what? Testing our trade. Time, entry, stop, and target right there. Okay, so here's the big 3. Is we talked about risk-reward already. So reward is likely, the scenario. So for example, it's what it needs to be likely. For example, realistic. If I have a stock and it's $100, well, how high could it go? Well, the potential reward is infinity, but it's not likely it'll hit infinity. Okay, so the reward is really what's likely. Well, maybe it goes to 110. That might be likely. That might be possible or probable. Okay, the risk is this, and I've always taught this. Start with the worst case scenario, the worst you could possibly think of. Armageddon, meltdown, bad things happen, especially with options more than stock. With stock, the worst thing is they go bankrupt next morning and it's different. But with an option, we want to just say, what's our max loss? In other words, what's the most we can lose when we talk about options? And then we try to minimize it from there. We try to work off of that number. But the other thing we have to weigh is probability. And these are what I call the big 3. The risk, the reward, and the probability. If I have a 90% chance of success and only a 10% chance of failure, that really affects how I trade. But if I have a 50% chance of success and a 50% chance of failure, that too affects how I trade. If I have a 90% chance of success and only 10% chance of failure, I might be willing to take more risk and take a little less reward. But I still have to know all 3. And then the other thing is if I'm going to take a trade like that, and I have a 10% chance of failure, I absolutely have to decide how I'm going to manage that if that worst case starts coming to fruition, how I can cut that off early. So we never make a trade without an entry, without a time, an entry, a stop, and a target. We never do it ever. And we never make a trade without identifying how much we could possibly lose, what is our likely gain, and then what is the probability of success. We're going to do that on every single trade we do in this course. Every single one, every single time. It is not a choice. We do test and we do the big 3. Comments, Corey?
Yeah, I mean, the 50-50, if it's a directional trade, usually the 50-50 type of probabilities, what do we want risk to reward? We want less risk, more reward, right? The 2-to-1 type of variety.
Minimum.
What if I say, well, the probability is heavily in my favor, 80%, 90% probability, something like that, and 10 or 20% probability of failure. Well, then I might be able to flip that and say, well, I'm willing to risk, 3-to-1 reward, or 4 or 5 or something higher as a worst case, and then even work it back from there, where I say, you know what, I might be willing to risk 5-to-1. It's so probable of success, but just because I'm starting with 5 in potential risk doesn't mean I can't improve from there, right? I can take my 3 potential risk and turn it into 2. So when I'm wrong, I lose even less than the worst case that I had planned for. And when you do that, you'll see that the numbers start to work in your favor. All of a sudden, you have not only good probability of success, but you're managing the risk in an appropriate manner where your losses are smaller. And when you get good at taking small losses, you become a great trader. That's really the key to success in my mind.
Okay, now this is a big one about diversification, and this is not my favorite risk management strategy. So we need to talk about the facts and the myths about what diversification can do. I talk a little bit about this in the 4 Pillars class. So if you've taken the 4 Pillars class, take the opportunity to review it right here. But I'm going to begin by saying this. Warren Buffett is a focus investor. He is not a diversification investor. In fact, if you look at Berkshire Hathaway's stock portfolio, I'll bet they have less than 50 companies. Would you say that's true? I've never counted them. But
yeah,
I'll bet there's less than 50.
And it's heavily involved in the consumer space.
Yeah.
So they're not diversified really all over into every sector. I mean, he was notoriously kind of away from technology quite a bit and just focused on what he knew.
He owns some Apple. That's about his only technology I can think of off the top of my head. But he owns consumer stuff like Fruit of the Loom and freaking Coke products. He's got a little bit of transport with some airlines and some railroads. And he's got a little bit of financials, Doesn't have a lot of pharmaceutical that comes to mind right now as I think about what's in his portfolio. Maybe a small drop of healthcare here and there, but he really cares about companies that he thinks are undervalued, and he's a value investor, and that's the stuff he looks for. He will sell things. He's getting out of IBM and into Apple. He will sell. Absolutely, he will sell. He's not, I'm going to buy this stock and hold it die. When the fundamentals no longer look good to him and he doesn't think he can go up anymore, he gets out. No question. He changes. Berkshire Hathaway divests of things. But he said this, and this is his famous quote, and he was really talking about, in the wake of this happened in the wake of the Enron deal. But he says, diversification is protection against ignorance. In other words, if I don't know what I'm doing, I just buy everything and I hope. So if you're a 401k investor, that's a sign of not knowing what you're doing. If you're a mutual fund investor and you're just trying to diversify at a risk, that's a sign of ignorance. It means it doesn't. Look, if you know what you're doing, it doesn't make sense to do it. And that's not my quote. That's Buffett's quote. It makes little sense to diversify if you know what you're doing. Why would you just buy 1,000 houses and hope and don't insure any of them and don't even look at any fundamentals or perspectives? I can't, I have great real estate investing friends. My 2 greatest real estate investing friends that I know are better than anybody else that I know personally. I'll give it 3. I'll give you 3. Number 1 is Than Merrill. Than Merrill is a stud, and he would never buy a house without looking at the fundamentals, the technicals, the cash flow, a prospectus on the deal. He would never just say, I'm just randomly going to buy a house hoping that it works out and that the rent's good and that everything works out. Kenny McElroy has 10,000 units that MC Company purchased and managed. They are a company that purchases properties and then manages the properties they purchased. I can't imagine you just going and buying any old apartment building saying, well, I've got 30 of them. I need 50 to diversify. I'll just buy this one. And if it works out, great. It doesn't, great. That guy's going to go through it with a freaking fine-tooth comb. The third one I would say of the people I know personally that are just awesome real estate investors is Kim Kiyosaki. Kim Kiyosaki, Robert's kind of a big picture guy, and, he just wants to see the big picture. Kim, she's interested in the details about that deal because she knows the devil's in the details. She sees both the big picture, and she's going to go through that thing and ask freaking questions. She's not just going to say, I want to buy another piece of real estate just to have more. And so the idea of doing that with a business, a commodity, and a stock is absolutely nuts. And that's why you can hear a little ire in my voice, Corey. I get a little bit angry with this, is people put money in their 401k with absolutely no freaking idea of what the fundamentals or technicals are on any of those companies. So I agree with Warren Buffett that this is stupid diversification. Now, this is one thing. This is the famous one I always talk about, so we won't spend much time on it. I hope you've seen this before for your 4 pillars class. This stands for broken pipe. This is British Petroleum. And years and years and years ago, this is a great example. They go from 60 to 30 minus 50%. And they say, see, if you had all your eggs in this basket, you'd have lost 50% of your money. So diversify, right? Well, here is the subprime meltdown at 1400 to 6. This is a 50% loss. And this is 500 companies right here. This is 5.
Yeah, that's the broad market.
This is the stinking Vanguard 500 right here. And this is exactly what the Vanguard 500 mutual fund looked like, because they just bought the S&P. And they did not do Warren Buffett. This is where John Bogle and Warren Buffett would part ways. Is John Bogle would say, look, it doesn't do any good to do research on these companies. Look, just buy these 500 companies. Just buy them. And hope that the market goes up long term. Warren Buffett won't do it. He's going to look at every single one of those 500. He says, nope, I don't want this one. Yes, I want this. Nope, I don't want this one. And let's say Warren Buffett, let's say he's got 30, I don't know how many stocks per share, maybe it's 30, 35. That means there's 465 of them that he said, I don't want for a reason. Right, in the S&P 500, and there might be stocks he owns that are not in the S&P 500. And so he is not, this is called systemic risk, this is called non-systemic risk. Diversification will offer protection against one company that stinks, no question about it. Diversification increases systemic risk because there's nowhere to hide. Warren Buffett in the meltdown of the tech bubble, right? Warren Buffett was largely unscathed relatively to other people because he wasn't in tech. He wasn't in the NASDAQ at the time because he said, look, they don't have the numbers, okay? This is all potential. They don't earn any money. I'm not going to buy companies that don't earn any money. Now that Apple has proven they can earn money, he's buying them, right? He's bought them.
Yeah.
So,
and the NASDAQ, the tech bubble, the NASDAQ lost 85% of its value, So you think about a major market, the entire NASDAQ composite, and it went down 85%, So to your point, the 401ks and the IRAs that are just
no control
in this systemic risk, well, they're basically hoping that their timing is going to be just right in retirement, because if they get to the point where the market goes down 60%, and then it stays there, and you get into a situation like Japan where it's deflationary and it's down for multiple decades, I mean, that's catastrophic for people in terms of their retirement. So it's a lack of control there, no doubt about it.
If control goes down, risk goes up. And if control goes up, then risk goes down. It's that simple. That's why we like options, because we can do some things. Now, I'm not saying that you should put all your eggs in one basket, okay? That's not what I'm saying, because if you have all your eggs in one basket, they can crash. So this goes back to what we were talking about with position size, okay? I don't want to have too much in one place. There is some truth. This is facts and myth. The fact is, it's true you don't want all your eggs in one basket. That is true. The myth is that if you diversify, you're protected completely. Let me say that again. This is about the facts and the myths of diversification. Putting all your eggs in one basket, stupid idea, fact, absolute fact, okay? Warren Buffett didn't buy just one company. He bought several, but he didn't just spread it around. He was focused and deliberate in what he did. And also, he's not just going to hold them forever, blindly hoping that the winners outnumber losers. He will manage them each one at a time. And when one is not performing to his goals and no longer fit his criteria, he will absolutely sell that stock. So there's truth that this is a bad idea right here. This is a bad idea, but it's false that diversifying will solve all the problems. True that this is a problem, but diversification is not enough. We want to have an exit plan for each individual stock that we buy. We want to have an entry, an exit, a target, a hedge, all that type of stuff. Anything else you want to say about that, Corey?
Yeah, I like to think in terms of course, we want some diversification, but you can think of in market terms of overweight, equal weight, underweight. And I like to do that just in terms of my positioning. So, I might like a sector or an area of the market, and that means I go overweight that area. That doesn't mean I put all my eggs in that basket. That means I focus on that area and I put a little more of my capital in that area of the market.
Right.
And when you think of it in those terms, it makes a lot more sense. We're not going to diversify blindly,
right,
but we're also not going to just go crazy and put everything all in one stock. And even further to the point, if you work for a company and you have your retirement and everything in that stock and you're being paid in that stock, then it gets even more risky in terms of not only if they go under, can you lose your job, but your stock can go down, which you might have all your retirement in. That would be a reason to kind of diversify some of those holdings typically away. It can be extra risky, basically, if not only your employment is on the line, but also all of your investments are in that business as well. That can be a lack of diversification that could be extra risk that you're taking.
And we'll talk a little bit more about this when we get the call to correlation. Now, Plan Bs and Plan Bs and Plan Cs and Plan Ds are important to have. What we want to do is it would be really nice to have a crystal ball to tell us what the future is. Okay, so if I told you that I could tell you the future, and then you could make a plan for that future, right, Corey? If I said, look, here's a plan for the future, so watch this. Create 3 crystal balls, okay? Create 3 crystal balls and say, I look in my crystal ball that this is going up. I look in my crystal ball that this is going down. I look in my crystal ball that this is going sideways. Now you have all 3 taken care of, and you can see the future in all 3. Then what you do is you say, all right, which one's most likely? Well, let's say we think that it's this one is most likely. So this is going to be Plan A. If you are wrong and it goes this way, you're going to have what? Plan B.
Plan B.
And if it's stagnant, and it stinks and goes this way, you're going to have Plan C. And then you're going to ask yourself this question. If it goes this way and I execute Plan A, will it make me happy? If it goes this way and I execute Plan B, will it make me happy? And if it goes this way and I execute Plan C, will it make me happy? And if the answer is yes to all 3 of those, you now have trading that makes you feel pretty good. So maybe Plan A is to make $2 per share. And maybe Plan B is to get after a month not losing any money. And maybe Plan C is to lose $1. And I say, you know what? At least I didn't, if I had Enron, let me ask this, the Enron people and the WorldCom people and the Hostess people and the Delta Airlines people and the GM people and the United Airlines people, all these companies that declared bankruptcy. How would you have felt if when Enron was at $90 a share, you sold at $89 and lost $1, and then it went down to 0? How would you feel if the stock went down to 0 and you only lost $1? Would you be happy with that? Could you live with that? Could you get good, like we talked about in the mindset section, of getting good at losing a little money? So I look at all these 3 and I say, you know what? I can live with this. My smile's maybe not as big. I can live with that, and I'll really be happy with this one. Now I have a plan for all 3, and I can trade without panicking and freaking out and having, trades that can really kill me. What do you think, Corey?
Yeah, I mean, it's a given that sometimes your crystal ball is going to be a little bit off. It's going to be a little bit cloudy, right? It's not going to do exactly what you thought. And even though you had a perfect plan, and if the market had behaved and this news announcement from the Federal Reserve hadn't come out, you would have made your $2. But you have to live we can't live in alternate realities.
Right.
There's only one reality we're living in, and that is the plan's not going the way you drew it up. So have a game plan where, okay, plan A is not working, I move to plan B. And if that one, isn't working, I move to plan C. And that's good trading because, again, it will get you in that habit of taking smaller losses.
Now,
and that's good.
This
That's
goes
a good
beyond.
approach.
This goes beyond. Watch this. This goes beyond just stock. Okay, we're going to talk a little bit later where your plan B might be sell half. That's a plan B. You say, look, if blank, then I will blank. And the key to this is before. Before, if I can write that with any type of legibility. The key to this is before. If the stock does A, then I will do B. If the stock does 2, then I will do 3. If the stock does X, then I will do Y. It might be to sell half. It might be to roll out one time, right? Or it might be to roll up and out or down and out one time. It might be to delta hedge with stock and buy some stock or short some stock. It might be to delta hedge with a future, right? It might be to beta weight the entire portfolio, right? And we're going to get into these types of hedges in plan Bs, which is a perfect segue into this. There's what the key word to this is adjust. Okay, is making adjustments. And we're going to talk about two types of adjustments, okay? One adjustment is to limit loss. That's the first type of adjustment, is to limit loss. We call this a hedge. So this is going to be really nice when we have risk graphs, because if I have a risk graph that looks like this and the stock starts going, this way, I need an alternate risk graph that will cancel that out and make it, delta neutral to where my net is, looks like this. If it goes down and I'm losing on one and I'm winning on the other, my net is here. So we're going to be talking about delta hedging as a way to hedge, which I think is a skill that you just don't trade. You don't trade an iron condor if you don't know how to do that. End of story. I'm so aggravated, Corey. I'm so mad that I was taught what an iron condor was. I was taught how to build it. I was taught how to put it out there, and I was never taught how to delta hedge. I'm so mad. I love my instructors. I love my teachers, but I'm not going to name names. But the guy that taught me how to do this, Iron Condor, taught me how to do it and spread trades without teaching me how to delta hedge. That's insane. That's freaking nuts. So we're going to be talking about delta hedging. I didn't understand about taking half off the table. This is your favorite, right?
It is. And it comes from when you're wrong in a trade and you take off half and you get smaller in size, it comes from the idea of doing the opposite of what you want to do. And so in trading, a lot of trading is about doing the hard thing in those key moments, right? And so if you think about what most people want to do, most people want to double down. They say, well, I'm down in this trade. I'm going to get bigger in size. I'm going to revenge trade, and I'm going to get my money back from this stock. They're not going to beat me. You dig your heels in. That's the common scenario, which is the wrong approach. We don't want to add more money to bad positions. That would be like, if you had real estate properties and you looked at all your real estate properties and there was one that was just a stinker and it couldn't make you any money, why would you pour more and more money into that project? You'd want to focus on the ones that are making you money and get rid of that bad one, Yep. So it's the same concept here. Because people want to add to bad trades, I'm a big believer that in that moment where you want to add to it, cut it in half. Do the opposite of what your instinct is to fight against it, and you'll do better results. So I love that approach.
right here, I have a house and an insurance contract. The insurance contract doesn't cost much in premium. And this is actually a cost if the house doesn't start on fire. But I'll tell you what, if the house starts on fire and the value of this house goes down to this, where it's just got a little land and the structure's gone, guess what happens? The value of this insurance contract goes up,
skyrockets,
to equal what this is. So what was once small becomes big when something big becomes small. That's called a hedge. And that's what diversification does not offer. I'm going to get on my soapbox a little bit here. I was really grateful for my mentor. One of my mentors is Robert Kiyosaki. I for 10 years as a Rich Dad advisor, the time I spent as a Rich Dad advisor, I learned a lot from him. I'll tell you, this guy's been one of my greatest teachers ever. And one of the books that he wrote is called The Unfair Advantage. And this is the Kindle version, The Unfair Advantage. And I put this in a nutshell. I says, look, amateurs, he was very kind in this, okay? People ask questions. And so he says, look, how does a person make money and reduce risk in paper assets? And the short answer was from Robert. And he said, start at the short end of the pool, take classes like with paper trading. That's the way to learn it. And then he says, in the world of investing, there's professionals and amateurs. The stock market's a great place for professionals because there's so many amateurs who are forced to be in the deep end of the pool where the sharks are. He says, I'm not good at paper assets, so it's best I defer to Andy again and let him explain the world from his point of view. He's great at investing in paper assets, a great teacher. Well, I'll tell you, I think Corey is a lot better than I am even. And he says, here's my explanation. So Andy Tanner tries to explain this. I said, look, in paper assets, there's two big differences between amateurs and pros. Number one is how we seek to generate our income is different. You're going to see that we want to sell contracts. We want to generate cash flow. We don't buy and hold forever like a 401k. And then B, it's how we manage risk is a different. And the easier the two discussions are about managing risk. And I blah, blah, blah and talk about it. But in a nutshell, most of the amateurs try to manage risk by diversification. But the professionals do it by using contracts called options. And so we will buy options to generate cash flow, or we'll sell options to generate cash flow, and we will buy options to hedge and use as insurance. So the first adjustment, right, the first adjustment you can make in a trade after you're in it is a good planned out plan B to limit loss. Do something to limit or neutralize loss. Now, the other adjustment you make, this is adjustment number 2. And we always want to look for opportunities to lock in a profit. In other words, every trade when you start, if it's worth anything, is going to have a reward, okay, and it's going to have a risk when you start. Every trade starts off this way. Okay, let's say I buy 5 call contracts, okay? Well, my reward is infinity. It could go up to infinity. And my risk is going to be the premium paid, okay? So let's say it's got this many dollar signs for what I paid. But as this stock goes up, okay, I would have the opportunity to, instead of buy calls, to sell calls for more money. I could sell different calls. I might decide to sell at a different strike, maybe 3 of these calls. And if 3 new calls give me the same amount of money of what it cost me to buy them, now I'll have 2 calls that are free and clear. There's no risk here. There's no risk. And so we're going to be talking about strategies for adjusting the lock-in profit, where we have risk graphs that look like this, where there's 0, this is your loss down here, this is your profit up here, and you can make an adjustment and you can actually get trades set up where you can eliminate the risk, and you can have an infinite upside and you can have 0 downside after an adjustment. They never start this way. But absolutely in the Mentor Club, I can't think of a time in the Mentor Club very often where we haven't had some of these trades where it's just flat out, there's no risk left in them because we adjusted. Comments, Corey.
This great way to trade. Locking in profits can mean, most people think of locking in profits as getting out of your trade.
Right.
That's the common approach. Oh, you're exiting, you're closing your transaction. No, we're not closing our trade. In the options world,
strengthening our trade.
We can put on an offsetting position. So, in other words, we're willing to cap our upside or do something to bring in as much money as we put into this trade, yet it leaves us with a position that is now risk-free.
Yes.
And you can put yourself in that position over and over again, and it is so smart in trading because once you've cashed out your risk, now think about your emotions.
Oh, yeah.
Are you super nervous about it? Are you watching every move? Are you going to be, panicky if it's not working for 10 minutes in the market? You're not going to feel that way. You're going to manage this thing appropriately. You're going to follow the plan because you've literally cashed out your risk. So it's great for psychology. It's great for that big smile we've talked about. And most importantly, it's great for profits.
It's one of the smartest things you can learn how to do. And again, I'm going to hammer that 401k again. When the heck do you ever lock yourselves into the 401k and lock in the profits there? You can't even do anything till you're 70 and a half, or at least 65. You got to start throwing it out at 70 and a half. You got to sit there till you're 65 years old and hope that thing goes up. You can't lock in a dime. You can't lock in nothing, unless you sell and go to cash, and then you got inflation risk. So, again, we're going to learn how to lock stuff in. And as the premiums change and the prices change, as the stock price changes, there are opportunities to turn trades into risk-free positions with zero risk. Correlation. Now, this is a problem. We said that with $100,000, maybe a trader only wants to risk 1, 2, or 3% of that money. So let's say a guy does 10 trades, okay? And all these trades only risk 1, 2% of the money. Okay, he does 10 trades. So let's look at the trend trades. The first one he buys is ExxonMobil. This next one he buys is Shell. The next one he buys is, maybe a Chevron. Next one we buy is the oil holders, OIH. The next one he buys is, what's the ETF?
ConocoPhillips.
Yeah, ConocoPhillips. The next one he buys is, what's the oil ETF? I always forget it.
XLE.
XLE.
Yep.
All these. And so now I got 1, 2, 3, 4, 5. I got 10 trades all in oil. Okay. If oil sucks and they're all marching in lockstep right here. Okay. If they're all marching in lockstep like this, did you like that? Did you like that little, graphic right there? Right. If they're all marching in lockstep, that's not having 1 to 2% in one place. That's like if we have 2% here, 2% here, 2%, 2% times 10, that's like having 20% of your money in one place. Does that make sense, Corey?
Yes. Highly correlated assets in that case, right? Because when you're trading Exxon and Chevron and Conoco, you could overlay those charts and you take away their stock symbol and you're not going to know much of the difference, right? They're going to look very, very similar.
For sure.
If oil's up, they'll probably be up. If oil's down, they'll probably be down, but they'll be moving together. So heavily correlated assets.
For sure. Absolutely true. So we'll be talking a little bit more about this, but I'll tell you, I would say go through this course, learn trading, paper trade, start trading a little bit if you want. But I would highly recommend, looking at the opportunity to get in like a small group mentorship or whatever to help personalize your plan. Because sitting here, Corey's hands are tied, my hands are tied because I don't know if you have a large account, small account, your age, your tolerance for risk, all those things. You want to work with an advisor and have a good team and say, look, this is what I want to achieve with my education. And then you can better learn the risk management strategies that will fit your risk tolerance. But definitely follow the 4 pillars. I mean, I think having a plan and having any system and sticking with it is a great way to reduce risk because you're eliminating emotion. You're going to be consistent. You're going to be using a trading journal, which helps you plan your trade. I'd say that's another one we could add to the list is plan your trade. Great lesson on risk management. This is number one mistake of new traders. No question about that. Can you remember what this stands for? Time, entry, stop, and target.
Yep.
The big three are always know your risk, always know your reward, and always know your probability. Okay, what is probable? None of them are perfect. We want to have a good idea of that. Diversification had some facts, but also some myths. Your plan Bs are how you make adjustments, and that's your three crystal balls for up, crystal ball for down, crystal ball for sideways. If you can put a smile in every one of those, I don't know if I can write small enough to smile in all of them, but if you can smile on all those crystal balls, you're going to have a lot less stress. Hedges is like insurance. Hedges are where you spend some money to protect other money, right? You spend some here to protect here. If you have an insurance contract on a house, you're spending a little money here to protect a lot of money here. That is better than diversification. This is how amateurs do it. This is how pros do it. I will say that with total fervor. Lock in the profits is another way to adjust. We want to be careful with too much correlation. And then finally, make sure you have a plan and you stick with it. Great lessons, Corey, on risk. Basic risk management. Again, I'm going to congratulate you for your patience in our style, in our course, because I know you're getting excited. We're only 3 or 4 lessons away now from really having the foundation ready to go into puts, calls, covered calls, all the strategies that everyone thinks this course is about. And that's what it is about. The majority of classes in this course are going to be on trading, on strategies, right? And how to do it. But I'll tell you, I can't imagine anyone that would say, "Yeah, I could learn this later." You know, I don't want to have an idea of how to manage risk until I learn how to trade this. That's crazy.
Yeah, it is. There's no chance you should be jumping into any strategy without having an understanding of position size and how, correlations of assets are going to affect you and some potential hedges and plan Bs. I mean, it's so critical. So great lesson.
Yeah, I hope you have a sense of pride in being able to come this far in the course without having learned a covered call yet or a naked put yet. Because when you look at all you've learned in terms of the depth of, we started with Greeks, for example. Should a person sell an option without understanding theta and vega and delta? No freaking way in a million years. Should a person trade without the right mindset? No way. We're going to talk about a trading journal. When should you learn about that? After you've traded a bunch or before, right? We're going to talk about a long-term wealth plan. Should you begin with an end in mind or just go out and start trading like a maniac? So I hope you feel a real sense of pride of learning this in the right order and having appreciation for you can hear it on our voices when we talk about position size, is saying, look, we're going to save you. We are going to save you from major pain, major mistakes, and major headache by having the discipline to have a good position size every single time. Rules that are unbreakable for you, right? You just don't. It's much like, I enjoy, I don't want to get political and have people hate me, but I do enjoy when I go out of town knowing that my wife, she's got a pistol. And if I go on somewhere and she's in a dark alley or going to the grocery store, she knows how to handle that and she trains on it. And so I love going to the shooting range. Well, my kids like to go. We're not hunters, but we do like the sport of the shooting range. And I'll tell you, when I tell my kids about those guns, man, those rules are freaking unbreakable. I mean, they even look like they're thinking about, pointing that thing in the wrong direction. I'm all over them. I'm all over them.
Yep.
And the same here is with you guys in position size. Doggone it, I hear about you having too big of a position size. I'm going to be all over you. I'm going to be all over you just as if, you were pointing the firearm in the wrong. Look, you treat that thing like it's loaded every time, and you treat that thing like it could go to the worst case scenario every single time. And if you shouldn't be scared of the firearm. It's an inanimate object. It only does stupid things around stupid people, right? It can't just sit there and hurt you if no one touches it. But if it's done the wrong way, it can kill you and it can kill someone else.
Yep.
Well, this is the stuff I'm going to tell you, that these are unbreakable rules. Okay. I know I'm a little parental when I say this, but I'm coaching you up, right? You don't mess with position size. You don't mess without tests. You don't mess without the big three. You don't count on just diversification. You have a plan B. You understand the hedges. When you get a chance to lock in a profit, lock it in, and don't mess with the correlation and work your plan. Tell you what, you commit to those rules, you're going to be a lot better off than if you don't. There's never a guarantee never to lose. Never. Every single trade has its risks. What I will say, though, is the people that do these things that Corey has taught is huge. Corey, you are an option principal. That's the number one reason I wanted to teach this class with you. This is your wheelhouse. This is what you do as an options principal. You get the last word on this one, buddy.
Well, I've seen profitable and unprofitable traders, and I know with absolute certainty that the people that adhere to these principles, position size appropriately and so forth, are the ones that are successful at the end of the day. So that's why we emphasize it. That's why we think it's so important, because it's meaningful. It makes a difference to how you're going to trade and to the quality of your trading. So great lesson. Great job as always, Andy. I'm loving it.
All right. We'll see you guys in the next one. I think we ought to talk about some long-term trading plans to begin with in mind, how to start off. A lot of people start out with almost nothing, and they want to know how to build it up. Corey, you started trading when you were very, very young. I knew you. I think I met you. What were you, like 21 when we met?
Yeah.
Years ago.
22 probably. This was almost 20 years ago. Yeah.
Yeah. You were not where you are now back then. I can tell you that right now. You were deciding, do I want to go to college? What do I want to do? You decided to be a trader. So I've watched you build what you've built, and I know your account size now is not what your account size was back then. So, I'm going to have
funny story about that. The first trade I ever put on that was a live trade, I think I had the potential to make like $11 or something like that. So, just understand that you start where you start, and that's fine, and so everybody understand that principle of you can build it up from there to where, now what used to make you $11 can make you thousands of dollars. Yeah. And that's the beauty of the financial markets. It doesn't care about where you come from, doesn't care about race, religion, any of that. It just cares about, are you making the right decisions? Are you managing the positions correctly? And if so, you'll be rewarded. So it's great.
I like making thousands of dollars in a trade. I remember I did a small trade with maybe just 5 contracts on a short strangle that I was in. And I think it was $1,600 was the amount of money to be made. And I thought it was funny because my first trade was on the Panera Bread Company, where I shorted it and I made $16 on that trade. So I made 1,000 times more later on, 1,000 times more later on than the first. Hey, you start where you start. So the next lesson,
that's right,
is Corey's really going to take the lead on. He's going to say, look, how do you start? Where do you begin? How do you build a long-term wealth plan? What are some of the things to think about? We're not going to just, give you just our opinion. We'll give you several different ideas for you to think about. And then you have a long-term plan. Then we'll do a trading journal, maybe review a little fundamental technical analysis. And after that, man, we are close. We are ready to hop in to some of these option strategies, having built the best foundation ever before someone starts trading options in a paper account. Great job, Corey. Great job for joining us. I'm stoked, man. I can feel the momentum going, man.
Feel the energy, right?
I can feel it, baby. So it's awesome. All right. Awesome stuff.